Question 1. An investor seeking current income with safety of principal would most likely consider an investment in which of the following? A. Common stock of a growth company. B. Callable preferred stock. C. High-yield corporate bonds. D. Equity options. Answer: B. Callable preferred stock. Preferred stock is a type of equity security that offers fixed dividend payments, making it suitable for investors prioritizing current income. While common stock dividends can fluctuate and high-yield bonds carry significant default risk, preferred stock offers a more predictable income stream. Callable preferred stock allows the issuer to redeem the shares, but it still provides regular income until called, offering a balance of income and a higher position in the capital structure than common stock. For investors focused on income, preferred stock often provides a stable dividend payment that can be more reliable than common stock dividends and less volatile than high-yield bonds. Question 2. A registered representative receives an unsolicited order from a client to purchase shares of a highly speculative penny stock. The client is a conservative investor nearing retirement. Which of the following actions is the most appropriate for the registered representative? A. Refuse the order and recommend a more suitable investment. B. Execute the order after explaining the risks and marking the order ticket unsolicited. C. Execute the order without further discussion, as it is an unsolicited order. D. Obtain written approval from a principal before executing the order. Answer: B. Execute the order after explaining the risks and marking the order ticket unsolicited. Even if an order is unsolicited, a registered representative still has an obligation to inform the client of the risks associated with the investment, especially if it appears unsuitable for their financial profile. While the representative cannot outright refuse an unsolicited order, unless it involves illegal activity or is outside the scope of their firm's business, they must document that the client initiated the transaction and was warned about the potential risks. Marking the order unsolicited serves as crucial documentation that the recommendation did not come from the representative, fulfilling suitability obligations. Ultimately, the client has the final say on their investment decisions, provided they are informed. Question 3. A client intends to invest $24,000 in a mutual fund and later add another $12,000, bringing their total investment to $36,000. The fund offers breakpoints at $25,000, $50,000, and $100,000. To ensure the client receives the lower sales charge associated with the $25,000 breakpoint on their second purchase, what should the registered representative recommend? A. Invest the full $36,000 initially. B. Utilize a letter of intent, LOI. C. Make the second purchase through a different fund family. D. Purchase the shares through a rights of accumulation program. Answer: B. Utilize a letter of intent, LOI. A letter of intent, LOI, is a non-binding agreement that allows an investor to qualify for a breakpoint by promising to invest a specified amount over a 13-month period. Although the client is initially investing $24,000, below the $25,000 breakpoint, an LOI for $36,000 would enable them to receive the reduced sales charge on all purchases within the 13 months, including the initial $24,000 and the subsequent $12,000, as if the entire $36,000 was invested at once. Rights of accumulation allow for breakpoint qualification based on past investments, but an LOI is for future investments to meet a breakpoint. Always consider how an LOI can help clients achieve lower sales charges when they plan future investments. Question 4. Which of the following statements is true regarding the taxation of municipal bonds? A. Interest income is always tax-exempt at the federal, state, and local levels. B. Interest income is generally federally tax-exempt, but may be subject to state and local taxes. C. Interest income is fully taxable at the federal level, but exempt at the state and local levels. D. Capital gains are always tax-exempt for municipal bonds. Answer: B. Interest income is generally federally tax-exempt, but may be subject to state and local taxes. Interest income from municipal bonds, which are issued by state and local governments, is typically exempt from federal income tax. However, whether it's exempt from state and local taxes depends on where the investor resides and where the bond was issued. If an investor buys a municipal bond issued by a political subdivision within their state of residence, the interest is usually triple tax exempt, federal, state, and local. If they buy a bond from another state, they will likely owe state and local taxes, though it remains federally tax exempt. Question 5. What is the primary purpose of a bond indenture? A. To specify the voting rights of bondholders. B. To detail the terms and conditions of a bond issue, including covenants. C. To determine the dividend payment schedule for preferred stockholders. D. To establish the reoffering yield for a new municipal bond issue. Answer: B. To detail the terms and conditions of a bond issue, including covenants. A bond indenture is a legal contract between the bond issuer and the bondholder that outlines all the essential terms and conditions of the bond issue. This includes the interest rate, maturity date, any collateral pledged, and protective covenants that the issuer must adhere to. Covenants are promises made by the issuer, such as maintaining certain financial ratios or not incurring additional debt, designed to protect bondholders. Think of the indenture as the bond's rulebook, ensuring both parties understand their rights and obligations. Question 6. A client invests $10,000 in a mutual fund with a net asset value, NAV, of $10 and a sales charge of 5%. How many shares will the client purchase? A. 950 shares. B. 1,000 shares. C. 900 shares. D. 975 shares. Answer: A. 950 shares. To determine the number of shares purchased, first calculate the public offering price, POP, per share by adjusting the NAV for the sales charge. The sales charge is 5% of the POP, so if the NAV is $10, the POP is NAV/1, sales charge percentage, which is $10/1 to 0.05, equals $10/0.95 equals $10.5263. A simpler way for a 5% sales charge is to first calculate the sales charge amount on the investment, $10,000 * 0.05 equals $500. This is incorrect as the sales charge is on the POP. The correct calculation is that the $10,000 invested represents the POP. The sales charge is 5% of the POP. So, if NAV is $10 and sales charge is 5%, then $10 is 95% of the POP equals $10/0.95 equals $10.5263. Number of shares equals total investment/POP equals $10,000/$10.5263 equals 950 shares. Another way to think about it is that for every $100 invested, $5 goes to sales charge, meaning $95 goes to buy shares. So, $10,000 * 0.95 equals $9,500 effective investment for shares. $9,500/$10 NAV per share equals 950 shares. Question 7. What is the primary difference between a market order and a limit order? A. A market order guarantees execution price, while a limit order guarantees execution. B. A market order guarantees execution, while a limit order guarantees execution price. C. A market order is placed only for buying, while a limit order is placed only for selling. D. A market order remains active until cancelled, while a limit order expires at the end of the day. Answer: B. A market order guarantees execution, while a limit order guarantees execution price. A market order is an instruction to buy or sell a security immediately at the best available current price. It prioritizes speed of execution but does not guarantee a specific price. In contrast, a limit order specifies a maximum price to pay when buying or a minimum price to receive when selling. It guarantees the execution price, or better, but does not guarantee that the order will be executed at all, as the market may never reach the specified limit price. Remember, market orders are about getting the trade done, and limit orders are about getting the right price. Question 8. All of the following are typically included in a customer new account form, except A. Customer's investment objectives. B. Customer's financial status and tax status. C. Names of beneficiaries for the account. D. Disciplinary history of the registered representative. Answer: D. Disciplinary history of the registered representative. A new account form is a crucial document that captures essential information about a client to ensure suitability and proper account administration. It includes details such as investment objectives, financial background, income, net worth, tax status, and employment information. While knowing the customer's financial profile is vital for suitability, the disciplinary history of the registered representative is part of the firm's internal compliance records and FINRA's broker check, not a standard element required on the customer's new account form. The focus of the new account form is the customer's information. Question 9. An investor holding American Depository Receipts, ADRs, is exposed to which of the following risks? A. Interest rate risk. B. Exchange rate risk. C. Liquidity risk. D. Regulatory risk. Answer: B. Exchange rate risk. ADRs are certificates that represent ownership of shares in a foreign company, trading on U.S. exchanges. When an investor holds ADRs, the underlying shares are denominated in a foreign currency. Therefore, fluctuations in the exchange rate between the US dollar and the foreign currency can impact the value of the ADRs and the dividends received. For example, if the US dollar strengthens against the foreign currency, the value of the foreign shares, and thus the ADRs, will decrease when converted back to US dollars. This makes exchange rate risk a significant consideration for ADR holders. Question 10. A limited partnership agreement typically specifies which of the following regarding income and losses? A. Income is taxed at the partnership level, while losses are passed through to partners. B. Both income and losses are passed through directly to the limited partners. C. Losses are deductible by limited partners, but income is taxed at the corporate level. D. Limited partners can only deduct losses up to their basis. Answer: B. Both income and losses are passed through directly to the limited partners. Limited partnerships are known as pass-through or flow-through entities, meaning they avoid double taxation. The partnership itself does not pay federal income taxes. Instead, all income, gains, losses, deductions, and credits are passed through directly to the individual partners. These items are then reported on each partner's personal tax return, allowing partners to utilize the partnership's losses to offset other income, subject to certain limitations like basis and passive loss rules. This pass-through feature is a key advantage for investors in limited partnerships. Question 11. Which of the following describes the cooling-off period in a new securities issue? A. The time period during which the underwriter solicits indications of interest. B. The period after the effective date when investors can purchase shares. C. The time after the closing of the public offering when shares are delivered. D. The period following an IPO when restrictions are placed on selling shares. Answer: A. The time period during which the underwriter solicits indications of interest. The cooling-off period is the 20-day period, or shorter, at the SEC's discretion, after a company files its registration statement with the SEC for a new securities issue. During this time, the SEC reviews the registration statement, and the underwriter can solicit non-binding indications of interest from potential investors using a preliminary prospectus, red herring. No sales can be made, and no offers can be accepted until the SEC declares the registration effective. This period allows the market to gauge demand and for investors to review preliminary information. Question 12. A customer wants to open a margin account. Under Regulation T, the initial margin requirement for common stock is generally A. 25%, B. 50%, C. 75%, D. 100%. Answer: B. 50%. Regulation T, issued by the Federal Reserve Board, governs the extension of credit by broker-dealers to customers for the purchase of securities. For the initial purchase of common stock in a margin account, the current Regulation T requirement is 50%. This means that the customer must deposit at least 50% of the purchase price in cash, and the remaining 50% can be borrowed from the broker-dealer. Broker-dealers can have house requirements that are higher than Regulation T, but they cannot be lower. Question 13. Which of the following is a primary characteristic of a structured product? A. It always offers a guaranteed rate of return. B. Its value is linked to an underlying asset or index. C. It is typically traded on a major exchange like the NYSE. D. It provides direct ownership of the underlying assets. Answer: B. Its value is linked to an underlying asset or index. Structured products are complex, pre-packaged investment strategies that derive their value from an underlying asset, index, or basket of assets. These products are often customized and can include features like principal protection, enhanced yield, or leveraged returns, but they do not always offer a guaranteed return. Their performance is directly tied to the performance of the specified benchmark, exposing investors to the risks of the underlying asset without direct ownership. Always understand the specific terms and risks of any structured product before investing. Question 14. Which of the following is most likely to be issued by a municipality to finance an income-producing project, with debt service paid from the project's revenues? A. General obligation bond. B. Revenue bond. C. Industrial development bond. D. Certificate of participation, COP. Answer: B. Revenue bond. Revenue bonds are a type of municipal bond issued to finance specific income-producing projects, such as toll bridges, airports, or water and sewer systems. The debt service, principal and interest payments, for these bonds is paid solely from the revenues generated by the project itself. This contrasts with general obligation, GO, bonds, which are backed by the full faith and credit and taxing power of the issuing municipality. For revenue bonds, the project's success is key to the bond's repayment. Question 15. A customer writes an equity call option and simultaneously buys an equity put option on the same underlying stock with the same expiration date but different strike prices. This strategy is referred to as A. Straddle. B. Spread. C. Combination. D. Covered call. Answer: C. Combination. An options combination involves buying and or selling both a call and a put option on the same underlying asset with the same expiration date, but with different strike prices. If the options had the same strike price, it would be a straddle. Because the strike prices are different in this scenario, one call written, one put bought, it forms a combination, often used to profit from significant price movements in either direction while potentially limiting risk. Question 16. Under FINRA rules, what is the maximum sales charge that may be imposed on an open-end investment company, mutual fund? A. 8.5% of the offering price. B. 9% of the offering price. C. 5% of net asset value. D. 8.5% of the net asset value. Answer: A. 8.5% of the offering price. FINRA rules, specifically Rule 2341, Investment Company Securities, limit the maximum sales charge that can be imposed on the purchase of open-end investment company shares. The maximum permissible sales charge is 8.5% of the public offering price, POP. To charge the maximum 8.5%, the fund must also offer specific benefits to investors, such as reinvestment of dividends at NAV, rights of accumulation, and breakpoints. This rule ensures that mutual fund sales charges are not excessive. Question 17. Which of the following risks is associated with owning a bond that has a callable feature? A. Reinvestment risk. B. Interest rate risk. C. Inflation risk. D. Liquidity risk. Answer: A. Reinvestment risk. A callable bond gives the issuer the right to redeem the bond before its maturity date, typically when interest rates have fallen. If a bond is called, the investor receives their principal back, but they then face the challenge of reinvesting that principal at a lower prevailing interest rate. This potential inability to reinvest at a comparable rate is known as reinvestment risk. Callable bonds benefit the issuer, but they present a disadvantage to the investor by increasing reinvestment risk. Question 18. A customer initiates a short sale. What is the minimum initial margin requirement for this transaction under Regulation T? A. 25%. B. 30%. C. 50%. D. 75%. Answer: C. 50%. Regulation T, set by the Federal Reserve Board, specifies the initial margin requirements for securities transactions. For both long, purchasing, and short, selling, positions, the general initial margin requirement is 50% of the transaction value. When a customer executes a short sale, they must deposit 50% of the value of the securities being sold short into their margin account, typically in cash or fully paid securities. This collateral ensures that the broker-dealer has a cushion against potential losses if the stock price rises. Question 19. An investor wants to participate in the growth of a company's stock but also wants to limit potential losses if the stock price declines. Which of the following option strategies would be most appropriate? A. Long straddle. B. Protective put. C. Covered call. D. Short put. Answer: B. Protective put. A protective put strategy involves buying a put option on a stock the investor already owns. This strategy allows the investor to maintain their long stock position and participate in any upside appreciation, while the purchased put option acts as an insurance policy, limiting potential losses if the stock price falls below the put strike price. For example, owning 100 shares of ABC stock and buying one ABC 50 put limits losses to $50 per share, plus the premium paid, even if the stock drops to $10. Question 20. Which of the following investment products is characterized by an undivided interest in a fixed portfolio of securities, has a stated maturity date, and is generally not actively managed? A. Open-end mutual fund. B. Exchange-traded fund, ETF. C. Unit investment trust, UIT. D. Closed-end fund. Answer: C. Unit investment trust, UIT. A unit investment trust, UIT, is an investment company that issues redeemable shares representing an undivided interest in a fixed portfolio of securities. Unlike mutual funds, a UIT portfolio is generally static and not actively managed. Once it's assembled, securities are held until maturity or until the trust terminates on a predetermined date. This fixed, or unmanaged, nature is a key distinguishing feature of UITs, contrasting with actively managed mutual funds or ETFs which trade like stocks. Question 21. A customer establishes a trust account with the following designation: Jane Doe, trustee for the benefit of John Doe. Which individual has the authority to make investment decisions for the account? A. John Doe. B. Jane Doe. C. Both Jane Doe and John Doe. D. Neither, as a third-party administrator is required. Answer: B. Jane Doe. In a trust account, the trustee is the individual or entity legally empowered to manage the assets within the trust for the benefit of the beneficiary. In this designation, Jane Doe, trustee, explicitly identifies Jane as the trustee, giving her the authority to make investment decisions and other administrative choices for the trust. John Doe is the beneficiary, meaning he is the one who will ultimately benefit from the assets but does not have direct control over them. Question 22. Which of the following statements is true regarding the taxation of dividends received by investors from a real estate investment trust, REIT? A. They are generally considered qualified dividends and taxed at favorable capital gains rates. B. They are typically taxed as ordinary income. C. They are usually tax-exempt if the REIT invests in municipal properties. D. They are subject to a 15% withholding tax for all investors. Answer: B. They are typically taxed as ordinary income. Unlike dividends from regular corporations, which may qualify for lower capital gains tax rates, dividends distributed by real estate investment trusts, REITs, are generally taxed as ordinary income for individual investors. This is because REITs are required to distribute at least 90% of their taxable income to shareholders to avoid corporate income tax, and these distributions are often considered non-qualified dividends. Keep in mind that while REITs provide a pass-through of income, that income is typically fully taxable to the recipient. Question 23. An investor purchases a municipal bond at a discount in the secondary market. If the investor holds the bond to maturity, how is the discount treated for tax purposes? A. It is considered tax-exempt interest income. B. It is treated as a capital gain. C. It is accreted annually and increases the cost basis, reducing the capital gain at maturity. D. It is considered ordinary income in the year the bond matures. Answer: C. It is accreted annually and increases the cost basis, reducing the capital gain at maturity. For municipal bonds purchased at a discount in the secondary market, the discount must be accreted annually. Accretion is the process of adjusting the bond's cost basis upward each year until it reaches par value at maturity. This annual accretion is treated as tax-exempt interest income, and it also increases the investor's cost basis, which means there will be no capital gain, or a smaller capital gain, if the bond is held to maturity and redeemed at par. This avoids a surprise capital gain at maturity. Question 24. What is the main difference between a registered representative's responsibility for a discretionary account versus a non-discretionary account? A. In a discretionary account, the representative makes all investment decisions without client approval, while in a non-discretionary account, client approval is required for each trade. B. A discretionary account requires a lower initial deposit than a non-discretionary account. C. Non-discretionary accounts are suitable for aggressive investors, while discretionary accounts are for conservative investors. D. Discretionary accounts are only for institutional clients, while non-discretionary accounts are for retail clients. Answer: A. In a discretionary account, the representative makes all investment decisions without client approval, while in a non-discretionary account, client approval is required for each trade. The core difference lies in who has the authority to make trading decisions. In a discretionary account, the registered representative has been granted written power of attorney by the client to make investment decisions, regarding asset, amount, or action, without seeking prior approval for each trade. Conversely, in a non-discretionary account, the client retains full control and must approve every single trade before it is executed. Discretionary accounts require careful oversight and specific client authorization. Question 25. Which of the following is a key characteristic of a variable annuity separate account? A. Its investment performance is guaranteed by the issuing insurance company. B. It is invested primarily in the insurance company's general assets, offering a fixed rate of return. C. It is separate from the insurance company's general assets and is typically invested in a diversified portfolio of securities. D. It offers a guaranteed minimum death benefit that is fixed at the time of purchase. Answer: C. It is separate from the insurance company's general assets and is typically invested in a diversified portfolio of securities. A variable annuity features a separate account, where the investor's premiums are allocated to a diversified portfolio of subaccounts, similar to mutual funds, chosen by the investor. This separate account is legally segregated from the insurance company's general assets, meaning its performance directly reflects the market performance of the underlying investments. Unlike the general account, which backs fixed annuities and offers guaranteed rates, the separate account's value fluctuates, and the investor bears the investment risk. This structure allows investors to potentially participate in market growth while retaining some insurance benefits.